Good morning, folks, and welcome to a morning update. Let's take a look at the yield curve. We are very close to closing out this month. This is a monthly chart, and while we are up on the month, meaning the spread between the 2s and 10s has widened out, the 2-year and the 10-year Treasury bond yield has widened out a bit. We are coming well off the highs of the month. This is bearish price action, despite the fact that we are up slightly. And I wouldn't be the least bit surprised if we go negative. If we go negative and we take out 0.18, which is the low of the year, between the spread between the 2-year and the 10-year Treasury bond yields, we will probably be heading towards recession. And you saw a similar price action right back here in February. And look at how that ended. Here we are today. So this is a bearish setup despite the fact that the spreads have narrowed. And it's concerning. This is our barometer, or one of our barometers for whether or not we are nearing recession. Now, yesterday, the 10-year bond yield pulled back significantly. And on the week, this is a weekly chart, the yields are down quite a bit. But despite the fact that we have pulled back this week, we're still firmly above 3%. The one concern I would have is that we are now back down below the 3.11 level, which was the high back in May and has acted as a support level. Now, why is that a concern? It's a concern because while the markets have been pulling back on rising yields, we've had a strong pullback on the week, yet stocks still decline. And that could be fear. It could be money leaving the stock market, moving into the bond market, and it's just a rotation of money from one asset to the other. And I think that yesterday, a good amount of the selling could have been attributed to the bombs that was sent to many Democrats. And there's a word for what we're seeing. It's an escalation of the A word, and that's anarchy. It's really beginning to build ahead of the midterms. So to ignore that doesn't make sense. So I still do think that we are going to get a rally fairly soon in this market. Do I think it will last? No, I said that the other day. I do not think it's going to last. The dollar spiked higher yesterday, a very strong day, on a flight to quality, a perceived quality, I should say. The Dixie, we are breaking out of this trading range at 95.84. If we close here, meaning Friday afternoon, 4 p.m. Eastern Standard Time, we close above this resistance level, in all probability, we are going higher on the US dollar. And you could lay the blame for that strength firmly at the steps of Europe. This is the euro. And the euro broke down very, very hard yesterday. I mentioned a few weeks ago when the battle between the Italian government and the EU Commission broke out that if Italy were to leave the Eurozone, you would see the euro disintegrate. You have the British that are now importing, I shouldn't say importing, they're stocking up on goods just in case they have to have a hard Brexit, meaning no deal with the EU, and all of a sudden commerce slows dramatically. So this is all bad stuff setting up over in Europe. And that's just the tip of the iceberg of what's going on over there. So we have the wheels coming off this global economy. The tips, daily chart. All right, so we're firming up here a bit. We have an undercut double bottom potential here. How do I know that it's a probable undercut double bottom? The minute that we clear 109.70, which is the pivot point. What is an undercut double bottom? It is when we pull back, rally. It appears as though we're going to set up a W formation where you would expect for the shares to put in a higher low or at least hold prior support, but they don't. What they do is they break down, traders blow out stops, and then as stop loss orders get filled, they step in and they take advantage of the share price, which is now on sale, and they bid it back up to close above support. What did they do yesterday? They pulled it back, retested as noted by this bottoming tail, and it appears as though we're going to go higher. Now you have the 50-day moving average, which is going to cross below the 200-day moving average. That's not good. However, you are seeing strength in the chips. That is a sign of inflation. These Stokes are looking really good. No breakout yet. However, RSI, we have a higher low and a breakout. This is the value of our indicators. We have a divergence forming here. The VIX rallied to a new weekly high yesterday. We have some stiff resistance above. Double bottom setup on Stoke RSI and rising. Higher low on Stokes, both lines back above the 50 level. MACD rising. So it appears as though momentum is at the back of the VIX. Way too early to call this rally over just yet. Weekly chart transports. We spoke about the weekly charts the other day and where would our line in the sand be. At that point in time, it was at the 10,000, 10,030 level. We are now firmly below that point, on our way down to 9,800, if not 9,600. This is bad stuff. Let's go to a daily chart to check out sequential volume. All right, so down volume is rising sequentially. So the selling is probably not done here. I would think that our next support level is 9,800. We are rallying in the pre-market, but it's only 4:30 a.m. here, Eastern Standard Time. Dow Jones Industrial Average closed out yesterday, brutal beating. New daily low, down nearly 2.5%. You can see by these topping tails, we attempted to rally yesterday. Resistance at 25.3. It was resistance the prior day. It was support 2 days prior to that. So it's time to update the chart and identify where we have new resistance above. So now we know that once we rally up to here at 25.3, well, in all probability, we're going to have sellers move in to sell because they just want out. So here is our upper band of resistance. When we rally up and into it, we will be looking to short the market. The S&P 500 daily chart down 3% yesterday. What a move. Broke down below support. Now here's that double bottom setup that formed back in April, then into May, and then we took off. We are now firmly down below that support level. At a bare minimum, I think we're coming down to 26.38, give or take a few points. Let's update this. All right, let's call it a range between 26.36 and 26.40 on the S&P 500. Don't be surprised if we get an overshoot to the downside. And I'm saying this despite the fact that the futures are up right now. The futures market, for us to see a bottom, should be glaring red right now. You want to see capitulation. And we don't have that yet. Not enough fear, believe it or not. But we are nearing a bottom here, folks. So we will be looking to buy stocks, not short them. The IWM daily chart crushed. We were down over 3.75% on the day yesterday on rising sequential down volume. Bloodbath. The banks, how happy are we that we stopped out of our bank position? So before we go to the DPST, we are selling off hard here. Big volume. DPST, the regional bank ETF, RSI 17.32. So we're entering a point here where we're going to want to begin accumulating a position. And I was hoping for a sell-off this morning. Hopefully we fade here. Let's go to the weekly chart, identify support. Remember, this is all about knowing where our historical support is, right? So, weekly chart. I think we may have overshot to the downside yesterday because we cleared support, closed down below support at 43.18. It was resistance back here in November of 15. The next stop for support, real serious support, would be at $31 per share to $35 per share, a pretty wide spread. So what we'll be looking for is a bullish reversal bar like we had here the week of January the 25th, or back here, when I say January the 25th, 2016, or back here July the 5th, the week of July the 5th, 2016. Okay, the next chart up, Nugget, daily chart. I received an email with regard to whether or not it's time to buy Nugget or add more Nugget. My answer was no, and the reason is that I'm simply not loving the price action just yet. Relative to the third standard deviation Bollinger Band back on the 15th of October, we got a little bit ahead of ourselves. We've been consolidating those gains, and that's all well and good. We have resistance above at 17, so we're aware of that. But yesterday we flashed a bearish reversal bar, and it was on a day where we had bombs being delivered to former presidents, secretaries of state, attorney general, etc., etc. You would have thought that Nugget would have rallied, but it didn't. Because gold and the miners are considered safe haven plays, and it didn't close up. Now, we can blame the dollar and say it's because of the dollar, but in times of fear, they can easily trade together. So we are holding support. Gold is up in the pre-market. It's off its highs. We'll go to the pre-market activity in a moment. Let's just show a little bit of patience here. Before we go adding more, Stokes, which were looking good, are beginning to weaken up here a little bit, as is RSI. FOE daily chart. This is the exact reason why we do not go jumping in with both feet. I still love the trade. Love it. If I liked it here on the 23rd, I have to love it now. So why didn't I go adding more yesterday? The reason is that we closed at the lows of the day, and we did so on volume, renewed rising down volume. Also, when you take a look at the weekly chart, we are no longer at a support level, which we were looking to hold at 1648 per share. So it appears as though we can come down here to 1563. I want to begin buying a lot more at that price point because it was resistance back here and it was support back here in June of 2015. Because this, going back to the daily chart, is completely unsustainable. We have RSI at 11.86, and we have a lot of shorts waiting to get squeezed. So we will look to go buying more shares of FOE as early as today. The DBA rallied yesterday, but reversed. No shocker. Expect a pullback and retest of the breakout point. We'll look to add more. Now, in terms of trades we're looking to put on, LABU, we're not there yet. However, we're nearing an oversold condition on RSI. And when I say oversold, I mean extreme oversold. RSI down below 20, like on the DPST. Let's go to a weekly chart of LABU to identify support. As a matter of fact, let's go to a monthly chart. 43.77 appears to be a good number to watch for as a support level. If that fails, we're coming down here to 40.90. And we'll look to begin buying at those support levels. So there are a lot of opportunities that are coming up for us to take advantage of. We just need to remain patient. Don't stare at your computer screen. Now let's get to the pre-market activity. Okay, good morning, folks, and welcome to Swing Trading Today. We just completed a review of the higher level view of the markets and where I believe that there are support levels on this market with members on a morning update. It's posted on the blog for those members who are just checking in now. So let's kick things off with the Nikkei. The Nikkei is up right now. We have these are all 4-hour charts. We have a bullish reversal bar on this 4-hour chart. It's 4:53 in the AM here. There will be a new bar that opens up in 7 minutes from now. So this is a fairly strong reversal bar, and it should portend higher highs today for the Nikkei. Note on RSI, we're putting in higher lows, no higher highs yet, but it looks as though we're getting a bit of a reprieve on selling here in the very short term. And we might even have some resistance here at the 21,663 level on the Nikkei. But it's not the Nikkei that's driving the market, right? What is driving the market? It's several things. We have not only geopolitical risk, we have, frankly, anarchy going on ahead of the midterm elections. And we also have anarchy taking place over in the EU. The battle of the Italians and the EU, as well as the British for that matter, continues. Let's go to the U.S. futures market. We have the NASDAQ, which is up over a percentage point, nearly 1.25% on the morning. Do I think that this is the bottom? Perhaps in the short term, but honestly, when you wake up after a big sell-off as we've had in the markets, rarely is a bottom created when you have bright green futures. Normally, you get capitulation and then a reversal day. We don't have that yet. So might we rally? Sure. Do I think that rally is going to fade? In all probability, yes, and we'll be looking to short the market. We've just discussed that I believe that there are opportunities to the long side. We do have a list of ETFs, stocks we're looking to add. We did some buying the day before yesterday. We'll be looking to buy some more. We're taking a very prudent approach to this market. We lightened up dramatically across the board on all long positions. The only serious long positions that we hold right now are the gold miners and some silver. And a single microcap stock that is just holding support. It really has been unfazed by this selling, knock wood. Let's go to yields. This is the 10-year Treasury note. So when you see a red bar, that means yields are rising. They are down on the week. We are, for all intents and purposes, flat overnight. We did get overbought on the 10-year Treasury note. So expect a consolidation, if not a further continuation pullback. That means that yields will probably move a bit higher today, or at least stay flat on the day. S&P futures, very similar to the NASDAQ in terms of price action, underperforming in terms of gains on a percentage basis. But there are reasons here to get a bit optimistic, very short term. Again, I don't think any rally is going to last. However, there's been a lot of damage done here, and there are opportunities, at least for a short-term swing trade. And you can see we have a higher low on the S&P futures, and we are beginning to poke out on RSI. Now, we've been here before and it failed, but we are forming some support here. But remember, this is a 4-hour chart, and you don't want to base your investment decisions on a 4-hour chart, perhaps a short-term swing trade, and then you move to the sidelines and you defer to your daily, weekly, monthly charts to identify where there is historical support and historical resistance. Now, the new bar at 5 a.m. Eastern Standard Time just opened up, so we'll be looking for a new higher high, and that will dictate how we open up this morning. So I think that we will have a positive open, but it doesn't matter where we open. What matters is how we close. Dow Jones Industrial Average, very similar to the S&P and NASDAQ. Taking a look at the currency markets, the US dollar, it closed off the highs of the session last bar. Because the last I looked at it, it was very strong. It was flashing a bullish reversal bar, implying that we would probably see higher highs. That has waned a bit. We've pulled back off the highs of the morning. So what I'll be watching for here, for an indication of which way the dollar is going to go, is to see whether or not this support level here holds, or do we break out above this upper band of resistance? Why does the dollar matter? Well, remember that the S&P 500 stocks garner much of their profits from overseas sales, roughly 50%. So if the dollar is strong, it makes U.S. produced goods and services more expensive overseas. Also, we are long of commodities. So gold is priced in U.S. dollars. So if the dollar breaks down, that should help gold. Now, lately, gold has been holding up just fine in the face of a stronger U.S. dollar. That is very, very bullish. Oil's been doing that for over a year now. That's broken a bit in these past several days. But the fact that gold is rallying in the face of a stronger U.S. dollar is very, very bullish for gold. That is a contrarian indicator. That is a signal by the market that there is accumulation of gold and even of silver, which is also broken out. You can see here we had some resistance. We broke out here on this 4-hour chart, rallied, pulled back, retested, rallied, pulled back again, retested. So what we're doing here is we're consolidating and we're looking for a breakout of this pennant formation. And a continuation breakout on silver on this 4-hour chart will send us right up here to 1488 on the spot futures price expiring in December. Checking out oil, attempting to consolidate here, and we are beginning to break out. Remember this bar just opened up right here. It's hard to see, but we're poking above this upper band of resistance. Let's highlight it. We're attempting to poke out above this upper band of resistance. Let's watch for a breakout. We're not going to know whether or not it's successful for several hours from now. Right now, all we're doing is flirting with it. A break below 66 on the crude oil contract. That would be very, very bearish. And we would have to avoid, like the plague, oil. But at current, we're beginning to poke out above this upper band of resistance, which is short-term bullish, very short-term. Okay, now let's segue over into member stock chart requests. We're going to begin with Deutsche Bank. You can do a search on my blog, and you could just type in DB, and you'll see that I have produced more commentary with regard to Deutsche Bank over the past year than you could shake a stick at. And by and large, that commentary, 99.75%, has been bearish. And I have warned over and over again that this stock is weak and getting weaker. I did not believe that this support level would hold. And I warned, beware of the single digits on Deutsche Bank because it is a money center bank in Europe, the largest in Europe, and it has counterparty risk to every single bank in the world that's considered a money center bank. So what happened this week? This is a weekly chart, if I didn't already mention that. We broke down below the lower band of support here. What was the low of the week until they salvaged it yesterday? $10 per share, right on the money, because they know exactly what's going to happen. This thing closes down with a 9 handle. This is bad. This is really, really bad. I mentioned earlier, you have a lot of anarchy going on over in Europe. Look no further than their banking system. It's an absolute nightmare. And it's not just Deutsche Bank. This is Credit Suisse. This is a Swiss bank. Annihilated. Look at this. This is the market sending you a signal. It's telling a story that the banks in Europe are in big, big trouble. So in looking at these charts, you need to expect some sort of intervention by their central banks. And keep in mind that Switzerland is not a member of the EU. Let's go to the daily chart. RSI 14.41 on Credit Suisse. Volume rising sequentially. This is bad, bad stuff. I'm not going to be shocked to see a rally here, but absent some sort of government intervention, these shares are going lower. This is a lack of confidence. Facebook, one of my favorite social justice warrior stocks, and they still don't get it. They want to be shills for the leftists in this country and in the EU, and they're going to lose their business, and they have no idea yet. For all the Harvard MBAs and MIT graduates over at Facebook, they have zero idea of what they are doing to their company. It's absolutely shocking. And it's not just isolated to Facebook. We have now closed down below 149.02. We closed out yesterday at 146.04. We closed out the week below 149.02. We're going down to 144.56 in a heartbeat. We could see it today. Daily chart. Look at this price action. We broke support yesterday on rising down volume. We're going lower here. We're rolling over on Stokes. We're going lower. And again, with Facebook, you can go over to my blog, type in FB, and you see all my negative commentary on Facebook going back months. And a lot of this damage, while yes, market related, but most of it was self-inflicted. HE. I've been bullish on HE. This is a utility stock. The utilities, despite the fact that yields have been rising, have been holding in really well. We broke out the week of September the 24th. We've been consolidating. I think we're going to break out here. I like these shares. We are slightly off the highs of the week. But if we close at or near the highs, and especially above 36.50, it's off to the races. Fitbit, daily chart. So we had a reprieve rally here. We peaked out on the 16th of October. And this is what I mean, what I'm looking for in this market. This is a microcosm of you need to draw your trend line down. Don't short into the selling, short into resistance. So I would have shorted here. However, while we had bearish price action yesterday, unlike the rest of the market, we haven't broken down to new lows on the year or on the month for that matter. On the month. So what I'd be watching for here is a reversal bar off of this 446 level or a higher low. If we hold and volume begins to drop off dramatically, you may consider opening up a long position. I would look to see whether or not you have a lot of shorts waiting to get squeezed here. If you don't have that and you don't have a really sexy valuation, there's other extreme oversold stocks out there that are setting up better technically. However, if you like the shares, you see value here, then go for it. However, if we break down below 446, you need to avoid the shares because they're going a lot lower. Now, RSI and Stokes continue to put in lower highs. So in this market environment, it's going to be tricky for the shares to hold 446. And again, if we break down below it, you need to avoid the shares. Unless, of course, they reverse to close back above $4 and let's call it 50 cents. Give yourself a little bit of room. The next chart, Disney. All right, another social justice warrior stock. What do I mean by that? I keep saying that. All of these companies, S&P companies, for God's sake, some of the smartest people in the world running these companies, and they feel obligated to jam leftist crap down your throat when you didn't ask for it. All you want to do is go watch a movie. And what did they do? They bought the Star Wars franchise and they trashed it. And these are the chickens coming home to roost. We broke down hard yesterday, really, really hard. And I think that we're going to break down below this lower band of support here. If we come down to 110.32 and close down below it, we're going down to 108.23. If that fails, it's all over for Disney. And that's exactly what I think is going to happen here. Lower highs on RSI, lower highs on Stokes. There's nothing good here. Volume. You have institutional selling. To buy these shares at this perceived support level right now is throwing good money after bad. I would avoid the shares like the plague, at least in the short term. If this support level holds, great. I'll talk to you next month. Let's revisit it. Right now, avoid. Amazon. The only reason why this is in the Social Justice Warrior Club is because Bezos is so arrogant. He uses the Washington Post to club a sitting president who's just as vindictive as he is. Good luck with that. So you have RSI making lower highs, lower lows. Stokes making lower highs, lower lows. I warned the other day that if we fail to hold the support level, we're going lower. We did fail. We are breaking down. I think that we are going lower on Amazon. Despite the morning futures, I think the air is going to come out of this stock in a very, very big way longer term. Simply take a look at the weekly chart. We have broken key support. The upper band of resistance is now broken. Amazon is officially a broken stock. I think that before we get a real serious rally, we're coming down to 1,500 on Amazon. I'll see you there. Set up an alert on your trading platform. Revisit it then. The EDC, Emerging Markets Bull ETF, I like it. Not yet, though. It's been damaged quite a bit, but not enough. You have the dollar, which is rallying. That is not good for EDC. In all probability, we are going lower here. I would not buy, but it is on our watch list to go adding. We're rolling over on Stokes, rolling over on RSI, double top down below the 50 level. We're probably going to go a lot lower here. To identify where there is historical support, let's go to our weekly chart. I think at a bare minimum, we're coming down to 57.45 on the EDC. We'll set up an alert. We'll revisit it then. No sense of watching it between now and then because we're simply not interested. And if that support level holds, which in all probability it will, I'll see you down at 53.57, which is last seen back in May 2016. Google, another social justice warrior stock. They've deemed themselves to be the free speech police. Hammered yesterday, down over 5%. How's your business model treating you? These guys, along with Facebook, Amazon, were printing money. Look at you now. How the mighty are falling. Weekly chart. I think that we're going down to, at a bare minimum, $1,000 per share here. And I know that's 57 points away. We could be there today. I think we're going lower. I would avoid Google unless you're going to short a rally. SFIX, Stitch Fix, daily chart. I would avoid these shares. We're in a downtrend. We gapped down on the 1st of October. We did rally. We pulled back, attempted to form a base. That base has now failed. Next support level, you could argue, would be where we bottomed out here on the 11th of October. And maybe it'll hold. Ideally, I would like to see a low put in here at around $20 to $21 per share, which is where you have more serious support than where we bottomed out on the 11th. We're rolling over on Ultimate Oscillator. Stokes are actually looking pretty good. So I would not buy these shares. I would wait to see whether or not these support levels down below hold, because if this support level breaks, we're coming down here to an 18 handle. So be very, very cautious. We're in a downtrend. Let the shares come to you. You're in no obligation here to buy and hope. Your obligation right now is to fear and to wait for the shares to come down to you. And trust me, they will. Just show patience. That's it for this morning, folks. Everybody have a profitable trading day, and I will talk to you soon. Be well.